Okay, so now let's try to understand about estimating receivables that are uncollectible. So basically there are a lot of receivables that don't get collected and they become bad debt. So now the core valuation principle is like the goal is like accounts receivable on the balance sheet should be reflected at their NRV, which is like whatever net realizable value we will be getting from accounts receivable, that should be shown on the balance sheet. Now, what is the NRV? NRV is like the amount of cash the company actually expects to collect. So there may be a situation that we sold for $1,000, but we are expecting that we will be receiving only $900. Then balance sheet should reflect only $900 to be received, right? Now, the problem is like the initial recorded AR, which are gross AR, includes the amount we estimate will never be paid. So, therefore, we must reduce the gross AR to reflect its true value, which is called as the NRV. So, basically, based on that, there are two different methods. First method is the direct write-off method, which is like not accepted by generally accepted accounting principle GAAP, and another method is the allowance method, which is used in the GAAP. So generally large corporations, listed corporations, big corporations refer this allowance method, and some small businesses, sole enterprises may refer this direct method. In the coming sessions we'll be going through these individual methods in detail.